Thank you for joining me. My name is Jonathan Wilson, and I'm one of the founders of FinCenReport.com. If you haven't heard about FinCenReport.com and the Corporate Transparency Act, we would encourage you to come out to our website, FinCenReport.com. We have summaries of the law and a free tool that you can use to find out whether this law applies to you. We're also tracking the regulations that are being implemented to bring this new law into effect, and we have frequent updates on those developments that you can track on our website. Today, I'd like to talk to you in a little bit more detail about what the Corporate Transparency Act is and what it requires. I've been a corporate lawyer for more than 30 years, and the Corporate Transparency Act is one of the biggest developments in corporate law in my career. The Corporate Transparency Act was adopted by Congress at the end of 2020, primarily to fight money laundering. Here's what we know so far. This law has been developed, and it requires FinCen to adopt regulations that are going to implement the law by the end of 2021. But there's still quite a lot of questions that are up in the air, a lot of gaps that Congress left in the law, and those are gaps that are going to have to be filled out by FinCen as they adopt their regulations. We're going to talk about some of the implications for businesses and financial institutions coming out of this law, and we're also going to talk about some short-term tactics and some long-term strategies that you can adopt to make sure that your business complies. Now, the background. The problem is that the United States, believe it or not, has become the money laundering capital of the world. Financial institution writers have been following this topic for years, and the primary reason is because of the way our corporations are organized and the way information about them is collected. Now, what is money laundering? Money laundering is the process by which a criminal organization takes their illicit funds and layers them in with legitimate funds in order to make the final outcome look like it's legal. When it's done the way the criminal organizations want to do it, it becomes really difficult for law enforcement to figure out whether the funds are legally gained or illegally gained. There are two primary methods. The first one is called smurfing. Well, one of the things that FinCen does under what's called the Bank Secrecy Act is they require banks and other financial institutions to file a report every time someone deposits more than $10,000 in cash. So, if you're an illegal organization and you've got $1 million that you need to launder, you break it up into little pieces that are less than $10,000, and you give it to a whole bunch of little people. Those are the Smurfs. The Smurfs deposit the funds into their own accounts and then transfer the money from there back to the criminal organization. The criminal organization then can characterize that money as income from some sale of goods or products, and it looks as if it's a legitimate transaction. In reality, they just laundered $1 million through a whole bunch of Smurfs. The other way that criminal organizations do money laundering is through what's called a daisy chain. The way this works is the organization will create 3 or 4 separate corporations. They'll deposit the funds in the first corporation, which will then transfer them to the second one, and then to the third, and then to the fourth. They will then dissolve corporations 1, 2, and 3, leaving behind no information about who the ultimate owners of those corporations were. At the end of the process, corporation number 4 is left with $1 million, is left with the ill-gotten gain, and it looks as if it's been derived from a series of legitimate transactions. Daisy chain transactions are possible because there is no record in the United States as to who the ultimate beneficial owners are of the different corporations. That's the problem that the Corporate Transparency Act is intended to solve. We know that this is a substantial problem in the United States because of a recent story called the Russian laundromat. In this transaction, this individual, who's actually a cousin of Vladimir Putin, the president of Russia, succeeded in laundering over $20 billion through more than a dozen different banks and institutions from various countries around the world through U.S. banks. He did it by using a combination of smurfing techniques and daisy chain techniques, but all of which ultimately resolves from the problem of having anonymous corporations where ultimate beneficial ownership cannot be determined. The Corporate Transparency Act is supposed to be the solution. This is actually adopted as an amendment to the Bank Secrecy Act and is going to be codified at 31 U.S.C. 5336, and the law requires that FinCen, the U.S. Treasury Department, adopt regulations to bring this law into effect by December 31, 2021. And that's what we're keeping track of at FinCenReport.com as we watch these regulations come out. The way the Corporate Transparency Act is supposed to work is that it requires a reporting company to file a beneficial ownership report. Now, what is a reporting company? The law is intended to be broad enough to cover just about every type of business. So a reporting company is defined as a corporation, a limited liability company, or other similar entity that's created by the filing of a document with the Secretary of State or a similar office of the law under the laws of a state or an Indian tribe, or that is formed under the laws of a foreign country and registered to do business in the United States by the filing of a document. In other words, if you are a business that files a document in order to have legal existence, then you are going to be a reporting company. That is why the definition is as broad as it is. Now, reporting company also includes several different categories of exemptions. We'll get into that later. Every reporting company has to file a report that identifies its beneficial owners. For each beneficial owner, the reporting company has to provide a full legal name, date of birth, current address, which could be residential or a business address, and either a unique identifying number from an acceptable identification document or that individual's FinCen identifier. With respect to this last category, we don't have a lot of clarity yet. The Corporate Transparency Act itself doesn't tell us where the FinCen identifiers are going to come from. Our best guess is that FinCen is going to adopt some sort of registration concept where individuals can apply for and obtain a unique FinCen identifier number, sort of like a Social Security number. But if you don't have a FinCen identifier, you're going to be able to use your Social Security number or your driver's license number. What's important, though, is that this beneficial ownership report is going to require this very personal information from every beneficial owner of every reporting company. That's a lot of information about a lot of people, and we know that name, birthday, residential address, Social Security number can all be used for identity theft. So it's going to be very important for small businesses and all the other reporting companies to find a way to collect and store this information securely so that it is not used for identity theft. That's one of the reasons we've created FinCenReport.com to create a secure online repository for this information for all of our clients who hire us to file their reports for them. Now, the Corporate Transparency Act defines the beneficial owner in basically two different categories. First, you're a beneficial owner if you own more than 25% of the ownership interests of the entity. There are some exclusions from this. We don't include minor children who happen to own stock in a company, for example. We don't include individuals who are acting as an intermediary or a custodian. We don't include individuals whose only interest in the corporation is through a right of inheritance. So if you inherited your stock in the company, we're not going to count you as a beneficial owner. And we're also not going to include creditors. If a bank makes a loan to a company so they have control through the loan agreement, we're not going to count the bank as being a beneficial owner. The Corporate Transparency Act cares about the true corporate owners of the reporting company. In addition to that 25% ownership test, there's also a substantial control test. The report needs to include both the 25% owners as well as any person who exercises substantial control over the company. Now, here's where we get into a lot of problems, because the Corporate Transparency Act didn't define substantial control. As the lawyers in the room will know, substantial control can mean a lot of different things. For corporations, officers and directors have a lot of control. They're able to sign contracts, make decisions. In many circumstances, they can bind the corporation by things they do and documents they sign. Did the law intend to pick up all the officers and directors of a corporation? We won't know until FinCen finalizes its regulations. Other persons who can exercise substantial control can include owners of a corporation who might have less than 25%, but still enough perhaps to put a director on the board or perhaps exercise a veto right over certain types of corporate decisions. Those entities can have control. Do they count for purposes of the beneficial ownership report? Again, we won't know until FinCen finalizes its definitions. And likewise, there can be other facts and circumstances that can give a party control, sort of like a veto power that might come through a shareholders agreement, for example. At the end of the day, the way FinCen puts its regulations together is going to have a really huge effect on how the Corporate Transparency Act is implemented, and it will affect all the obligations that small businesses have to comply with this new law. Now, how can we measure ownership? Okay, the Corporate Transparency Act assumes that a 25% owner of a company is easy to define, But in many situations, it's not. In my practice as a corporate lawyer, I'm often involved in putting together operating agreements for limited liability companies. And in your average real estate venture, there could easily be 4 or 5, 6, 7 different LLCs put together just for one real estate project. You might have one LLC that is owned by the person who owns the land, another LLC that's owned by the real estate developer, another LLC that's owned by the financing party who's putting together financing for it, and there could be another LLC that's used for example, crowdfunding to raise some of the equity capital required for the new project. Those entities themselves might own other LLCs that in turn own the LLC that's at the bottom of the pile that is the ultimate owner of the real estate. So in that situation, you could have 7 different LLCs owning a piece of one property. Well, you're going to have to look at 25% ownership for every one of those different LLCs. It can get more complicated, believe it or not. Inside of the operating agreement of many LLCs is what's called a waterfall. The waterfall might say that 50% of the first million goes to this investor and the other 50% goes to everybody else. And then with respect to the next $1 million after that, it gets divided this way. And the next $5 million might be divided a different way, and anything in excess of that is divided some other way. Well, if that's the waterfall with all of these different percentages based upon the first million, the second million, and everything after that and so on, who's the 25% owner? Congress didn't tell us in the law. Again, we're not really going to know how this comes together until FinCen finalizes its definitions, which we hope will happen before the end of 2021. But keep checking back to FinCenReport.com as we are staying up with these regulations as they get adopted, and we're going to be giving you updates as time passes. So if you're a reporting company, you have to file a beneficial ownership report about all of your beneficial owners. But not every company in the United States is going to be required to file. The Act created 24 different categories of exemption from the obligation to file. Whether or not your company falls into one of these exemptions is almost always going to require you to consult with a lawyer or to carefully review the regulations. We're also providing a free tool on FinCenReport.com that allows you to use a series of drop-down menus to figure out whether any of these exemptions apply to you. So check back to see how this applies to you on our website. One of the most common exemptions that we expect many small businesses will need to look at is called the grandfathered private company exemption. You are exempt from the obligation to file if you employ more than 20 employees in the United States on a full-time basis, you have filed federal income tax returns in the United States demonstrating more than $5 million in gross receipts in the previous year, and you have a physical office within the United States. Now, when Congress passed this, the idea was that if you were an established business, more than $5 million in sales, a physical place of business, and more than 20 employees, you were pretty well established. If we wanted to know who you were, we could come to your place of business, ask one of the 20 employees, and we could find out who the ultimate beneficial owners of the company were for purposes of fighting money laundering. The challenge with this is there are some businesses that might be right on the cusp. Maybe they have 19 employees, maybe they have 21 employees, maybe their sales are a little bit over 5 million or a little under 5 million. The Corporate Transparency Act says that if you're exempt today, but you're not exempt tomorrow, you're now obligated to file. So if this exemption applies to you and you breathe a sigh of relief having made it past the first filing deadline, your job is not over. You're going to have to pay attention to this exemption on a day-to-day basis moving forward to make sure that you don't become non-exempt and all of a sudden take on an obligation to file. Another exempt type of entity is the charitable foundation. Anything that's basically a nonprofit entity under Section 501c of the Internal Revenue Code. Now, if you're a nonprofit, you know that you're a nonprofit, but it's important to remember that the nonprofit exemption only applies to public charities. It does not apply to private foundations that are exempt under Section 508. So, if you're a nonprofit of some kind, you need to check your exemption status, and again, we can help you with that at FinCenReport.com. Another form of exemption is the subsidiary of an exempt entity. I might have mentioned the publicly traded exemption. Publicly traded companies, people whose stock is traded on the NYSE or the NASDAQ, you are exempt if you're publicly traded. The idea is that if you're publicly traded, you're already filing financial statements with the SEC. We know where you are. We can find you if we're law enforcement. A wholly owned subsidiary of a publicly traded company is also exempt under this particular exemption. But be careful, the exemption only applies to wholly owned subsidiaries. If a publicly traded company has a wholly owned subsidiary and then, for compensation purposes, perhaps peels off a little equity to a business partner, peels off some equity in some sort of arrangement to a group of employees, peels off some equity to someone else, now that subsidiary is no longer a wholly owned subsidiary and the exemption no longer applies. So again, just because the corporation is exempt on day one doesn't mean it will always be exempt. The Corporate Transparency Act requires you to continually monitor your exemption status, because if you cease to be exempt, you all of a sudden develop an obligation to file that beneficial ownership report. Now, timing is going to be very important. Nobody can file anything right now. FinCen hasn't finalized their regulations. We expect the regulations will be finalized by December 31, 2021, because that's what the Act requires. Until the regulations are finalized, though, nobody can file. Once they are finalized, the clock begins ticking. According to the Act, any company in the United States that is required to file has 2 years from the date the regulations are implemented to file their first report. That doesn't mean you should wait 2 years. You want to get it done before the 2-year time runs for a bunch of different reasons we'll get to later, but that 2-year clock begins running. But a newly formed corporation, formed after the regulations are implemented, is obligated to file its first report at the time it is organized. Now, this creates a different problem. I might have mentioned earlier how in the average real estate transaction, it's not unusual to have 4, 5, 6 different LLCs. Those will often get formed in anticipation of the real estate transaction. Parties will file their articles of organization with the Secretary of State before we even know which player is going to own which entity, who's putting in so much money, what percentage they're all going to get. But they are formed and they legally begin to exist when the articles of organization are filed with the Secretary of State. Well, as written, the Corporate Transparency Act requires each of those LLCs to have filed their first beneficial ownership report at the time they are formed, meaning at the time their articles of organization are filed. The problem is the lawyers don't even know who the owners are at the time the articles of organization are filed. Hopefully, this is going to be one of the gaps in the law that FinCen fills in when it finalizes its regulations. We're keeping track of those regulations at FinCenReport.com, so check back on our website for more updates. Now, as with any law, compliance is important, but there are penalties for non-compliance with the Corporate Transparency Act that can be very severe. A person who fails to file is liable for $500 for every day that they're not in compliance. They can also be fined for not more than $10,000 and imprisoned for not more than 2 years. But that's not the worst of it. If FinCen ends up prosecuting a corporation for a financial crime like money laundering, tax avoidance, things like that, then the failure to file the beneficial ownership report gets compounded, and the fines can be as much as $500,000 and imprisonment for up to 10 years just for the failure to file the beneficial ownership report. So, moderate penalties for a more honest failure to file, severe penalties for true bad actors who are trying to evade their obligations. And that's really what the Corporate Transparency Act is meant to prevent. Now, the Act says that there's going to be some kind of safe harbor and some sort of self-correction mechanism, but the law doesn't really tell us how that's going to work. Because FinCen's ultimate incentive is to get as much information as possible and to get the broadest possible reporting from the largest number of companies so that they have a really comprehensive and robust database, we expect that FinCen is probably going to be fairly liberal with their safe harbor and self-correction methods. We don't know exactly what it's going to look like, and we won't know until the regulations are finalized, but we expect that there will be some sort of an opportunity for the small business who accidentally fails to file to somehow perhaps pay a late fee and get in compliance even after that deadline has passed. Now, that doesn't mean you shouldn't take this seriously. It's still a crime for failing to file. So check out our resources for you at FinCenReport.com. Find out if this law is going to apply to you and find out when your filing deadline is going to be so that you are not late and you don't have to worry about a self-correction mechanism. We would be happy to answer any questions that you might have. Come out to our website at FinCenReport.com and post your question in the forums at the bottom of the page. We'll respond to questions, and you might even see questions that other people have answered that will bring to mind some ideas that you might not have thought about before. There are some key questions to be resolved in the law. For example, substantial control. We talked about that earlier. A person in substantial control of a reporting company has to file a beneficial ownership report, but we don't know what substantial control means yet. FinCen is going to have to tell us in their regulations. How are individuals going to get their first FinCen identifier? The FinCen identifier is going to be a special number, kind of like a Social Security number, that individuals can get that they can use over and over again when they are required to be reported in multiple different reporting companies. We don't yet know how an individual is going to apply for and obtain their FinCen identifier numbers. We also don't know exactly what the reporting duty of an exempt reporting company is going to be. If a company is exempt and doesn't have to file a report, is FinCen going to require them to file a report that says that they're exempt, and why? It's quite possible. FinCen raised the possibility in their advanced notice of public rulemaking that they might do just that. So, important to keep up to date on the regulations as they come out. Check back to FinCenReport.com for all of the updates as the regulations are finalized. Now, for lawyers, accountants, and people who are actively in the business of founding new companies, financing companies, doing corporate M&A transactions, your practice is going to change in a variety of different ways. First, as it comes to capital formation, entities are going to need to adopt provisions that compel their investors and shareholders to report all the required information and changes in that information in an orderly way. Imagine that you have a real estate company with 4 or 5 different investors that have anywhere from 20 to 25%, and they do deals amongst each other, swapping interests in the company. Well, the company itself needs to know every time one of those deals happens because it affects the beneficial ownership of the company, and it triggers a duty to file an amendment, file an updated report to FinCen, alerting FinCen to that change. If there isn't a provision in the LLC operating agreement or in the shareholders agreement in the case of a corporation, the corporation might not have the ability to get the information to allow it to timely file. So the investors could actually hurt themselves by not putting these sorts of corporate governance measures in place when they get started. In addition, corporations and LLCs and other reporting companies are going to have an ongoing compliance duty to keep track of changes in beneficial ownership, changes in address, changes in phone number, and so on as time passes. Every time that there is a material change in one of those data points, the Act, as currently written, starts a 1-year clock running on the reporting of that change. So if you have a corporation that's in compliance on day 1 and they change something on day 2, you now have 365 days to file the amendment that gives FinCen notice of that change. Now, unless someone is keeping track of these changes and keeping track of the deadlines, you really run the risk of missing a filing deadline. So the best way to do this is for your company to adopt a compliance officer and empower that person to collect the information they need, and at the same time obligate that person to keep track of these deadlines and keep track of these reporting obligations. The Corporate Transparency Act is also going to change the way we do mergers and acquisitions. As anyone knows who's been through that process, it is a lengthy and very detailed process to do what's called due diligence in an M&A transaction. You'll often get a spreadsheet that would have several hundred lines on it of all the discrete, granular pieces of information that the lawyers and the accountants want to collect about a company before they can paper up the transaction to buy that company. Well, they're going to have to add a few more lines now because it's not exactly clear who is going to have the liability for filing the beneficial ownership report under the Corporate Transparency Act. In other words, if Corporation A merges with Corporation B, and then after the merger, someone figures out that Corporation B wasn't properly in compliance with their Corporate Transparency Act obligations, does that liability stick with the post-merger combined corporation? And if so, what's the measure of that liability? That's something that M&A professionals are going to have to keep track of as they do diligence in M&A deals going forward. In addition, One of the challenges in the Corporate Transparency Act is that it compels duties on the person who files the report. Well, if you're a lawyer or an accountant and you fill out the beneficial ownership report for one of your clients and then cause it to be filed, what is the nature of your obligation? Are you taking on a felony crime if you inadvertently file a document that contains information because the information your client gave you was incorrect or not entirely complete? That's something we don't know yet, and it's another reason to keep track of the regulations that FinCen is developing throughout 2021. Now, there are some steps that everyone can take now. First, they can get educated. Come out to FinCenReport.com, read our summaries of the law, read our reports on the ongoing obligations, and make sure that you're aware of the regulations as they come out. Second, every company in the United States today ought to go through the exercise of determining whether they think they are going to be exempt or not. Come out to our website at FinCenReport.com and use our free tool to find out whether you are likely to be exempt based upon the way the law is written. If you are going to be exempt, you need to keep that fact in mind and be aware of the factors that support your exemption. To the extent that you have transactions in the next few months before the regulations are finalized, you should be aware whether the transactions you're engaging in are putting that exempt status at risk. It might be a good transaction to do anyway, but be aware of what you're doing and how it affects your exempt and non-exempt status under the Corporate Transparency Act. In addition, it's not too early for every company in America to begin to think about who is going to have the obligation to keep track of their compliance status. What tools is that person going to need in terms of the ability to collect information, the ability to store that information securely, and how are we going to provide oversight for that compliance officer to make sure that they are filing their reports on time and staying up on all of their duties. Well, I appreciate your time learning about the Corporate Transparency Act today. For more information, come out to FinCenReport.com. You can post a question in the forums. You can read our blogs. You can watch out for our newsletters as they come out, as the FinCen begins to adopt its regulations to implement this new law and bring it into effect. Thank you for your time, and we look forward to hearing from you.